All right, investors, we're going to revisit an old favorite here, BYND. I don't know if it's that favorite for investors anymore, but we got a lot to talk about here. Actually, not that much because looking through the 10K here, there's not much information listed for some reason. But anyways, first, a quick overview of the company. I'm going to try not to be too harsh on it right now, all right? But look at the website, guys. I think I have a seizure and I'm getting motion sickness from watching that same close-up image over and over and over again. It's kind of like sitting on the first row of a movie theater. It's giving me a little bit of a headache. But anyways, besides the website, it looks like they've expanded their products quite a bit. I remember seeing some interviews with the leadership of the company some time ago, and that's exactly they were working on, and it looks like they are succeeding when it comes to that, expanding products and all that. I don't want to go through the website too much. Okay, they have meatballs, burgers. They're expanding into other categories. I remember them trying to imitate fish and all that kind of stuff, but that's not what I want to talk about. Okay, what I want to talk about is the financial house. The big distinction that we got to make here is between the products and the company, right? I mean, even Aston Martin had to be bailed out, and that company is legit. I mean, the products are legit. I still want an Aston Martin. I don't care how well the company's ran. I want one right now, right? Really badly. So we have to separate the two. Just because the product might be good doesn't mean the company is going to return capital to you. Like I said, I made a video on Fisker, the car company, and I said, well, buy the car, but you don't have to buy the company. Just because something has a great product, it does not mean that it will automatically generate cash for you. Now, I think the company is doing a good thing, right? They're trying to service a population in the world that is looking for a more diverse vegan or vegetarian or whatever diet, and that's great. That's fantastic. They've been doing some kind of like association or research to help treat cancer through better food products and this and that. I think that's admirable. That's great. But what is going on with this company, guys? I mean, I'll try to be nice. Because it's it's a legit company, and it's fine. I'm sure everybody that works for this company is a good person and means well and everything. But look at this price action. It tells you everything you need to know. Okay, 6.26% down today for no news, at least not that I can find. Right, down 9% on the month. Year to date is actually up 10%, but look at that year chart. What's going on here? 5-year chart. So it used to be as high as $200 per share back in 2020, in its heydays when people were really excited about this company. Now, $14. So the company has lost over 90% of its value. That's quite a bit. 90% is a huge loss. Okay? You think 80% is bad? Well, 90% is a 50% loss from down 80%. It's not good, guys. Not good. So let's take a look immediately into the financials, because this overview is not going to tell us much. Perhaps we can quickly learn something from this bar here. It should give you a nice picture of what's been going on with the company. Even though it's a small one, you can tell what's going on. So the revenue is in blue, earnings are in red. It's basically almost all you need to know. The company looked like it was doing well here from 2018, 2019, even 2020, a little bit of increased losses here in 2020, but the revenue was going up. Look at 2021, guys. Revenue slowed and the earnings kept getting hit. They failed to make profitable decisions at that time. It's okay for a growth company to do that for many years even, but there's a unwritten contract. By the way, 2002 is horrendous. Horrendous 2002. But there's an unwritten contract. When you're investing in growth companies, investors are going to be willing to keep giving you money and buying your issued equity or whatever, or giving you money as in form of debt, they're fine with that as long as one thing is happening, and that is expansion. As long as the revenue is growing, they're willing to sit it out and see if you're eventually going to be able to turn things profitable. Like, that's the unwritten contract. Okay, that's the handshake that people make. And if you fail to fulfill that side of things, if you're the growth company, if you fail to keep growing, then people are going to start like scratching their mustaches and start pulling some of that money away. And that's exactly what's been happening with Beyond Meat. It's exactly what's been happening. So let's go and get a good picture of what's happening with this company's numbers. First, we're going to click quarterly, and look what's happening. All right. They had the second best quarter here in the third quarter, I guess, 2022. But at what price, right? And this 2 quarters in 2022, absolutely unexcusable. Why isn't this revenue growing? Why are these quarters less than like the previous 3 years? That's 3 years of supposed growth. They're getting less revenue. What? Not good. No wonder the stock's tanking. All right, let's move on here. Perhaps they've made adjustments to their net income, right? Nope. And maybe a little bit in the last quarter they've lost less money. But still, look, the company is shedding like $100 million per quarter. Not the best outcome. At least they're not diluting the shares. Okay, they're not diluting the shares, at least not by much. The reason for that is because they had a $1 billion offering of convertible notes that went into effect in March 2021, I believe. And we're going to look at that next. So we'll go to the balance sheet, quarterly, cash and cash equivalents. You can see this big cash infusion here in April of 2021. This is when the auction happened. And they've been bleeding that cash ever since, every quarter. Do you see this? Bleed. Every quarter. Soon they're going to run out of cash to spend. And then what? Then they're going to get stuck with that debt, and now we're going to have to tap the investors for more. Give us more money. We're good. We're good for it. Give us more money. Yeah, we're not growing, but give us more money so we can continue to lose it. You know, not good. Not a good look. Even if the people running the company are good, like, that's just not a good look, guys. Total debt. There. Here's the offering here in 2021. And it's actually, the total debt has been increasing a little bit over time. Also not a good sign, right? You can see similar situation here under the statistics. Market cap of under $1 billion. Enterprise value of almost $8 billion. That tells you that they're sitting on quite a bit of debt. We can find out exactly what our net cash position is, which is negative $871.19 million. $870 million in the hole. And that number is going to keep increasing. It has been increasing, and it's going to keep increasing. More and more debt. There's nothing else we can learn from here. EV to sales, except right here, is 4.21. It's not horrendous, but that's not a good trend. I think it's been increasing. Profit margins, of course, is sitting at an embarrassing minus 87.4. Minus 87.4. So the cost to generate that revenue is just way too much. I mean, I expend, Freudian slip. I expect for a company to have these kind of numbers, but they have to be really growing revenue. I understand if you're trying to ramp up, production and things like that, get new facilities going. Sometimes you can have that expense going without much revenue. But it should be intertwined, right? It should be a process where you're trying to increase one and the other. At least the factories or whatever that are functioning need to be increasing sales at the same time you're expending money for new factories. Like, why would you expend if your demand is actually shrinking? Speaking of demand, let's take a look at some charts. First, what is happening with the world and eating meat versus buying meat substitutes? Well, this is what the picture looks like right now as of December 2022. So South Korea really not into buying meat substitutes, but the rest of the world is kind of catching up on it a little bit. They're willing to do it. It's very interesting to me that India, only 53% of Indians eat meat. I would have actually thought it'd be less. I thought there was a very cultural, negative attitude towards meat eating, but I guess a large portion of India doesn't share that kind of culture. I know India is very multicultural. They have 36 or 3,600 different tribes and languages or whatever. But I thought they shared that a little bit more throughout the countryside here. Anyway, United States stands at 87% eat meat. That's quite high. And then 14% are eating. The reason why these numbers don't add up to 100 is because you can be a meat eater, right? Like in South Korea, but yet still be purchasing meat substitutes on occasion. Like, I've done that, I've done it. What else can we learn here? That meat substitutes are a very small portion of meat, quote unquote, eating. Total meat eating, including the substitutes. Yes, it's growing, and it's growing kind of fastish. You can see in 2018, 19, 20, these are kind of extrapolations. I don't know if it's going to get that big, but this is what the projections are, 2018 to 2027. I don't know the last year that's been filled out with real data. I'm guessing it's somewhere around, let me see if I can find that. When is this article written? March 30th, 2023, so it's pretty fresh. No pun intended, I guess. Yeah, sorry about that. So, it's made this year, 2023, so the data is pretty good. The extrapolations, I don't know, maybe they're even optimistic. I'm willing to bet that this liver is going down. Why am I willing to bet that? Well, check out the next graph. This is Google Trends data, and look what's been happening over the last 5 years when it comes to these three topics. The three topics are vegan. Up top blue is vegan diet. We got in red paleo diet, and in yellow we got vegetarian diet. All of them are kind of decreasing over time. Vegan diet was most popular in January 2020 or December 2019, and then it's been dropping. Similar idea with the vegetarian. So overall, people are not getting more and more interested into this topic. Okay, it's just not. All right. The other thing I have a problem with Beyond Meat and other companies that are going into the meat substitutes business is the price, man. How expensive is this? Right? Every time I go to a restaurant and order one of those Beyond, meat products or Impossible Burgers or something, they're so expensive. They're more expensive than getting a regular hamburger or a regular steak or whatever I'm buying. It's ridiculous. How am I supposed to afford this? I mean, I thought being plant-based would be actually cheaper. And why haven't they made efficiencies to try to bring the cost of production down? I understand that with big scale you can bring the production cost down, but I mean, it's time. This company has been public for over 3 years or so. It's actually a 15-year-old company. This company's been around for a long time. They should have had at least some thought on creating efficiencies in their company. So I'm not a fan of just borrowing money just so you can sustain a company that has not made any improvements when it comes to efficiency. I mean, you have to be more efficient. You got to do it. You can't just blow money like crazy. You guys remember what happened to Oatly? I mean, that company's still around. But it looks like a similar thing. I mean, let's take a look. Are you curious? So this is the max, right? since their IPO'd, I guess, somewhere in 2019. And not good, guys. I think it peaked out. Look at this, 234.90. So more than a 90% drop. Let's see. Only all these like trendy food product companies. Max, oof, that hurts. 28.73 all the way down to $2.22 per share. I'm sure it's a similar story. If we go to the financials, let's see what's going on here. Quarterly, yeah, stagnating revenue. I mean, it's better than declining revenue. I know this is a Beyond Meat, but I just want to illustrate the pits and falls of growth companies. Okay, net income quarterly, negative 125 million. Not quite diluting shares, but that's okay. Profit margin decreasing. Ooh, negative 64. It's better than Beyond Meat, believe it or not. Let's take a look at the balance sheet. What's going on with their cash position? Oh, so they had an offering or something in 2021, and then they've been spending through that billion. So they're in the same boat as Beyond Meat, guys, and they're burning through their cash. Right? Total debt. There you go. 151. So back to Beyond Meat. I went into their 10K to try to figure out, get a better idea of the numbers. I know it's a little cut off on the left, but you don't really need to see what's going on. I just want to mention one thing, okay, which is their convertible, basically, liabilities right here, which is, convertible senior notes, net $1.133 billion. Okay. So it's sitting right there. It was interesting how the assets and liabilities were structured in their report. It's a little different than the other companies. I don't know exactly why they did that. But that's besides the case. I couldn't really dig up any important relevant information besides the fact that they have production plants in different places, maybe 7-8 places. They have a couple big ones in California. They have a couple in China, in Greater China, and they have some in Europe, etc. So I'm not sure when they were built and what their expanding schedule is, but all I know is that, especially with these interest rates in today's world, not many investors are going to be putting up with this chance of at some point being able to be a profitable company in a market that's arguably also, just like the EV market, saturated and way too niche. Look at this. All right, one sec. Check this out. Juicy Marbles, have you heard of it? This is just one of many competitors. There's a website here where you can find out the competitors of each company. This company is only 4 years old, and look what it's doing. Plant-based whole cuts. Okay, what does that mean? We're able to make a product with actual muscle tissue that has a texture like a proper steak. So it probably has better texture than Beyond Meat. This company was formed 4 years ago, Dover, Delaware. I have no idea whether it's public or private. It's raised 4.63 in its latest round, seeding round. I don't know if it's the first one or third one or whatever. But this is all, irrelevant. What is relevant is look at all these competitors, right? These are all competitors. Yes, Beyond Meat has a brand, right? But brands are very easily tarnished. If someone comes along and does a better job managing the company than they are, they will become the new hot thing for investors, right? In this niche market. And just because there's an opening, just because there's a market opening up, okay, just like with anything else in history, any other market in history, whether it's a South Sea, right? Remember that stock, South Sea? What was it? I forget. Whether it's tulips, whether it's oil, whether it's cars, airplanes. There's going to be a ton of companies that are entering the field, EVs, a ton of companies entering into the field, trying to make the next best product. But in the competition, in the fever of competition, there's going to be a lot of money thrown out, and you're constantly going to have to throw money at your project, at your company, in order to stay on top, to stay competitive. Because if you don't, you'll fall behind, and you get eaten up by the company who's willing to do that. So there's so much competition in new emerging industries like the meat substitution service, that the competition is so great and so cutthroat that burning cash is the norm. And only in mature industries, or in very, very few exceptions, is a company able to swim out and actually return money to its original shareholders. One of those was Tesla. All right? And there's still, if you bought it back then, and there's still, it's a question when its current valuation being so high, whether or not if you buy now, it will ever return money to you. It's a very good question. But my point is that it's extremely difficult, okay, to figure out which growth company is going to actually make it. The payout could be huge, but it's like 1 in 1,000, guys. It's a very small chance. So anyways, that's what I wanted to say. Beyond Meat, it's very tough. I wouldn't buy it at all. I don't know if it'll ever return any money to shareholders. That $1 billion debt is going to be hard to pay off, and they're probably not going to be profitable for quite a while. They're probably going to tap the investors for more money, dilute the shares at some point, probably. Even though the price is already low, they're going to have to do a reverse split and then dilute, or tap the investors for more debt. I don't know what they'll have to do, but they're definitely losing money at a steady clip, and the revenue doesn't seem to be getting any better, nor is their efficiency. So unless they prove to investors that they've turned the ship around and they can make the necessary moves to turn this into a legit company, I fear that the stock will not make huge strides forward. Perhaps a short squeeze, that's fine, but you can short squeeze anything. Yeah, there could be a big short squeeze. I don't know, but eventually that thing is gonna fade until the underlying company starts doing better. That's my opinion on the matter. Hopefully you all enjoyed this. Peace out. Mic drop.